Hello and welcome to Pro Trader Strategies Market Commentary for Monday, August the 21st. It is the solar eclipse day. I'm sure you haven't heard about that. No, everybody's talking about it because there's really not a whole lot else to talk about. It seems like there's no economic data today in the markets and it's a pretty quiet week for the most part. We are going to be getting some flash PMI numbers across the pond later on in the week on Wednesday, and we also have the Jackson Hole Symposium starting, which gives you a lot of insight into what the overall economic picture is and a lot of insight from good insight, I should say, from the FOMC members. So keep your eyes out for that. There's going to be a big brain trust there talking about different things. But anyway, I got to go over a couple of things. Please remember that past performance in any trading system or methodology is not necessarily indicative of future results. And my name's Eric Wilkinson. Some of you may recognize me as Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement in your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get it on. As you can see here, crude oil down about 90 cents after Friday's massive rally, well over $1 rally on Friday. When we were talking, it was not nearly what it ended up being. It was just a blast off to the upside in crude oil today, giving back almost half back those gains. So crude oil down on the day, not any real news, just it's having some big massive trading ranges due to the fact that people are really starting to try and battle it out on their positions. I think that they were really trying to get above that fib level, this where the most volume has been trading. You know, I've talked about it closer to the 50, but it's really closer to the 49 area and really came up short. So when those bulls kind of exhausted themselves to the upside trying to get to that mark, today we're seeing the repercussions of that as they kind of all started folding. So that giving up quite a bit of ground today. On to the gold futures. Gold's up nicely today, almost $5. That having to do with a bit of a flight to safety. There's some mixed bag in the overall equities, so gold is rebounding quite nicely today off of that. Then with the bonds, they're up slightly on the day, up by about 4 ticks, which is really, for all intents and purposes, unchanged. They don't really have a whole lot of room to go, despite the fact that there's been some unsettling stuff coming out of the equities. So today we got a mixed bag and everything's kind of settling down, just with a really quiet market, no data points to really talk about. As you can see here, on Friday we did get that blast off. When we were talking, VIX was looking like it was going to push higher, but the market's rebounding over the weekend. VIX really settling down as well. So volatility really coming out of the market, which I'd like to see volatility start to spike after we get through earnings season, which we pretty much are. There's very few earnings that I'm going to even really be looking at this week. There's maybe 1 or 2 the whole week. So I've got to start adding some stuff to my portfolio that have high implied volatility so I can take advantage of some of that volatility crush coming out of the markets going forward. So, and I'll talk about what I've done there as well. But the Dow Jones Industrial Average up 10 points and well off its lows of the day. NASDAQ off its lows of the day, but still in negative territory by about 14 points. Real support acting like we would expect it to right here around this 57.80 area. So that is going to act as a nice little support area for the NASDAQ. On Friday, the bulls were not able to get it back above that 50-day moving average. Today, tried again and have since failed so far in the day. But that's going to be the key line in the sand to discern whether the bulls and the bears are kind of taking control here. As of right now, below that 50-day moving average, and the bears are winning in the NASDAQ. The E-mini S&Ps, one thing, this chart is a little bit suspect in the sense when you get this big down sell-off, it looks like, Friday's chart setup that doji was going to act as support, but now we've got a counteracting doji, and a lot of times that will indicate a continuation pattern to the downside. So unless we can start really pushing this market higher, if it were to settle right around where we are now, that could very well indicate more downside, but we need a confirmation to that. If the market settles below Friday's low, then that's definitely going to look like a continuation. But even right here where it is now could be a setup for a continuation pattern. But we need confirmation for that in order to really call that a continuation. This is the 30-minute chart of the E-mini S&Ps as they're coming off right now, off of the highs of the intraday session, where we tipped out on those, now starting to give a little bit back because it was a pretty good rally off of the open for the most part. Market's starting to give a little bit back, probably a lot of profit taking going on. Anytime you get that move, we moved above where Friday's point of control is. A lot of people probably going to look to take profits at that area. So I think that's what we're seeing right now. Now, on to a few things that I've done with XLK. On Friday, I added this when we saw this doji in the broader markets with what I showed you in the E-mini S&Ps. I stepped in a little bit earlier, which is what I have a tendency to do before it gets confirmed. But in XLK, I went in there and sold some puts. In the September, I sold the September 55 puts, and I sold those for 31 cents. It's trading a little bit higher than that, about 37, so I'm down about a nickel on those. So with XLK in this market, looking for the technology sector to rebound a little bit. It's very closely tied to the NASDAQ, and as we saw, Dow Jones, E-mini S&Ps in positive territory, but today the NASDAQ's still in negative territory, which hurts XLK. But like I said, I got into that market a little bit early before it got confirmed, so I have wanted to add also some longer deltas to my portfolio with the past several days of sell-offs heading into that, or with at least Thursday's massive sell-off. Thought it looked like it was bottoming, so I added some long deltas using XLK. Not really looking that great right now, plus it's got really high implied volatility, which is what I want to take advantage of. It's not helping me out right now, but have on some long deltas in XLK, short those 55 puts in September. On to the triple Qs, I was able to get out of these, actually able to get out of a trade in my IRA due to directionality. If you remember, I had to hold on to that spread I had on a short call spread. I was able to get out of those calls in my regular margin account rather early, and I've talked about that many times. Anytime you have on a short call spread or a short put spread, you have to take a little bit more risk than you would if you were naked, and that turned out to be the case just the same. I'm able to get further away on the naked side and collect even a better credit, if you will, than having to do the call spread and get closer to the market, which increases my risk, and I'm not able to get as much of a credit. But today I was able to get out of those September call spreads, and I was in the September short the 146 and long the 147 calls to create that short call spread, right in line with my rules for that. Collected 31 cents at initiation on that, was able to buy it back for 16 cents. Pretty close for government work, if you will, as of 50%, taking 50% of my max profit on that. So was able to close that position out. Now in the flip side, going over to the IRA, or from the IRA back to my margin account, added some long deltas in there using triple Qs, kind of similar to what I did with the XLK, but kind of spreading that out a little bit. Went in there and sold the September 136 puts for 91 cents. So added some long deltas, kind of lockstep with that XLK mentality, with thinking that we may have found a little bit of a bottom here and at least get a little bit of rebound. Volatility comes out, that will help those two positions quite nicely. And then on to Facebook. With Facebook, I took this trade off for 50% of my max profit. And if you remember in Facebook, I had on the September strangle, and was short the 150 puts and then short the 185 calls in there, and originally sold that for like 91 cents. Was able to buy it back for 45 cents today. Now that Facebook trade I had on as a GTC and was able to get out of that, so that was nice. 50% of my max profit on that one. And basically due to volatility coming out in this market just kind of moving sideways right in between those strikes is exactly what you want from a strangle. And again, with a strangle versus an iron condor, I'm able to get a lot further away and collect a better credit for that. So in a sense, it seems like you're taking more risk, but that risk increases that reward. But I look at it as I had less risk on with that naked strangle than I would have with an iron condor, because an iron condor would have been tighter to the market, and volatility doesn't really come out of those tighter iron condors nearly as fast as when you're further away. So that works out nicely for that trade out of the Facebook today. In the XLI trade, which is the last one I did, got out of it in my IRA and in my margin account. I had on the September, and I was long the 71 puts and then short the 65 puts to create that long put spread. Originally paid a debit of $2.33, $2.33. Market comes off in there, was able to get out of that trade for $3.80. So that's right there in line with the 50% of my max profit on that. You basically take the difference in the width of the spreads and take 50% of what that profit would be on top of that, and that puts you right in there at the $3.80. So got out of both of those, IRA and in my margin account, so out of the XLI trade. So, and that's about all I got for you guys. Friday's webinar is going to be on the put diagonal. XLK. Did I talk about XLK? XLK was one that I added to my margin account, so I did talk about that one. So good. So Friday we're going to be talking about how to do a put diagonal. Great setup for earnings, because we're going to be taking it. We're going to exploit some volatility in the front and theta decay, and then we're going to be taking advantage of volatility expansion in and around the next earnings season. So I'm going to show you how to set that up, because even though we're kind of still slightly in this earnings season, it's really pretty much wrapped up, but this will give us the perfect opportunity for some of those stocks that release earnings earlier on in the season. Those will be falling right in line with this diagonal spread, and I'm going to show you how to do that in the webinar. All right, so go to protraderstrategies.com to sign up for that. If you can't take that, take it easy.